Does investor behavior make a difference in your returns? And can poor behavior actually ruin your returns? We're going to go over an example of when that happens, coming up next. Hey, my name is Mel Stubbs. I'm a financial planner at Christy Capital Management, where we're trying to help federal employees plan for a more successful retirement. If you need help, click right up here. Well, it turns out that investor behavior makes a huge difference. And this is probably not a shock to anybody, but if you see this article right here, there was a fund called CGM Focus, which was the best performing stock mutual fund for the decade ending back in 2009 for that 10-year period. The man in charge was Ken Huebner, and he did quite well. If you look right here, his fund that has $3.7 billion in it, it rose more than 18% annually, which outpaced its closest rival by more than 3 percentage points. So that means that you get a 10-year average of 18% each year. And that sounds great if you stuck with them through thick and thin. If you remember back then, there was the dot-com crash, then there was the 2008 crash. And things were very volatile, and so it tends to make people make some choices that in hindsight may not have been good. So the fund itself has it was the highest performing fund for those 10 years, but if you look right here, too bad for the investors, who didn't enjoy those same returns. A typical CGM Focus shareholder actually lost money. That's right, they lost 11% annually for that 10-year period ending November 30th, according to Morningstar Research. And so that sounds crazy. How is a fund that's making 18% a year on average for the 10 years, yet the average investor was losing 11% each year? It has to do with their behavior. Now, the fund's hot and cold performance is probably what caused it. During 2007, it surged 80%, which caused people to put $2.6 billion into the fund because it did so well. But then it sunk 48% in 2008. So then investors pulled a bunch of money out. And then in the first 11 months of 2009, the fund was up 11%. But remember, people pulled their money out. So people are putting their money in after the funds had a huge run. And if you think about it, they're buying it high. And then the fund has a setback, which all funds will have a setback. People pull their money out, which is selling it low. And so chasing stock market returns generally does not work out very well. And when you wait for a fund to go up a whole lot to finally put your money in hindsight, that hasn't always worked well. So I just relate this to the TSP. The funds in the TSP may not be quite as aggressively invested as this fund, so it may not have the wild swings that this fund had. But your investor behavior does matter. You don't want to go with the flow. It makes more sense to figure out your risk tolerance, to set up a portfolio that matches that tolerance. Whatever portion of your money that you want exposed to the stock market, you put that in the stock market. The stock market will have some good times, the stock market will have some bad times. And leaving the portion of money that you've earmarked for the stock market, let it stay in the stock market to ride out the highs and the lows. Because historically speaking, that is done better. Trying to time the market is often difficult even for the smartest expert. Trying to time the market in your retirement account when you're spending your full time on another job and not really paying attention to the markets is not likely to happen. The only way the people in the CGM Focus Fund received the best returns for the decade was leaving the money invested and riding it out over time. Now that only makes sense to let your money ride it out over time if you're willing and comfortable to have that portion of money be in the stock market. So the question is, how much of your portfolio do you want to participate in the stock market? Notice how I say participate in the stock market, because sometimes it goes up and you'll participate. Sometimes it goes down and you'll participate. How much of your portfolio do you want to participate? If you set that up correctly, then the need to try to time the market and move in and out will be less enticing. So here's just a quick example of how chasing returns doesn't always work out for the benefit, and actually in this case it was to their detriment. Sometimes your investor behavior can be your enemy in retirement. The other two enemies in retirement? Well, that's what this video right here is all about. The two things that can mess up your retirement. If you need help, go to christycapital.com, click Talk to an Advisor. Hope to talk to you soon.